Warren Buffett bought his first stock at age 11. 3 shares of Citi's Service Preferred at $38 each. By 30, he had around $1 million. By 50, he had about $300 million. Those are numbers most people will never see in their lifetime. But here's what almost nobody talks about. His net worth today is around $130 billion. And roughly 90% of that came after he turned 65. So the man who is considered the greatest investor of all time spent over 54 years of his career building what most people would call not that much. And then time did something extraordinary to it. Most people look at that and think, I don't have 65 years. I need something faster. That instinct is exactly what keeps people broke. The game most people are playing is a speed game. Get in, get out, get rich. And the financial industry is very good at selling that idea. Trading apps, crypto tips, stock alerts, option strategies, all of it is packaged to look like a shortcut. Like there's a faster route that smart people use, and you just haven't been shown it yet. Here's the data. Studies consistently show that 70 to 80% of day traders lose money within their first year. Not just underperform, lose. They end up with less than they started with. A large-scale study of the Taiwanese stock market followed tens of thousands of traders over 15 years. Less than 1% of them were profitable consistently. 1%. And that 1% wasn't winning because they found a better app or a smarter system. They were mostly winning because of advantages that regular people don't have. Faster information, institutional access, or just playing in volume that a regular salary can't support. The person who opens Robinhood with $2,000 and starts day trading is not competing against other beginners. They're competing against algorithms, hedge funds, and professionals who do this for 10 hours a day. The outcome is usually predictable. So what's actually going wrong here? It's not the market. Markets go up over time. The S&P 500 has averaged around 10% annually over the last 100 years. The problem isn't where people are playing, it's how long they're staying in. The people who lose money aren't losing because investing doesn't work. They're losing because they're using a long-term tool on a short-term timeline. It's like planting a seed and digging it up 3 days later because nothing happened yet. Now let's talk about how this actually works, because once you see it, it changes how you think about money entirely. Compound interest is the idea that your returns earn returns. Not just your original money, but the growth on top of it, and then the growth on top of that growth. Here's a real example. If you put $300 a month into an index fund starting at age 25, and it grows at 8% per year on average, after 30 years, you'll have around $408,000. You contributed $108,000 of your own money. The rest, about $300,000, came from compound growth. You didn't earn that with skill, you earned it with time. Now look at what happens if you wait just 10 years to start. Same $300 a month, same 8% return, but only 20 years instead of 30. You end up with around $165,000. That 10-year delay cost you roughly $243,000. And here's what makes it worse. You actually contributed less of your own money in that shorter time frame and still ended up with far less. Because what you cut wasn't your effort. It was time. This is why time is not a passive ingredient. Time is doing the heavy lifting. You're not waiting for something to happen. You are actively deploying the most powerful force in personal finance by simply staying in. The curve of compound growth is not a straight line. For the first 10 to 15 years, it feels like almost nothing is happening. The graph is nearly flat. People see that and give up. They think it's not working. Then somewhere around year 20, the curve starts to bend. By year 30, it goes almost vertical. This is exactly what happened with Buffett. The math was always working. He just didn't quit during the flat part. So what does a system actually look like? Because long-term investing isn't just a mindset. It's a set of decisions you make once and then protect. Step 1. Choose the right assets. For most people who are not finance professionals, the answer is index funds. An index fund buys a small piece of hundreds of companies at once. When the overall market goes up, you go up. You're not betting on one company. You're betting that the American economy keeps existing, which historically has been a safe bet. Step 2. Automate contributions. Set up a recurring transfer into your investment account every month. $100, $200, $300, whatever fits. The automation removes the decision from your hands. You don't have to feel motivated. You don't have to remember. It just happens. Step 3. Don't touch it. This is the hardest part. Markets will drop. Your portfolio will go red. Something in the news will sound terrifying. The instinct is to pull out, wait for things to calm down, and get back in later. That instinct has cost people hundreds of billions of dollars collectively. When the market dropped nearly 34% in March 2020, it recovered to new highs within 6 months. The people who panicked and sold locked in their losses permanently. The people who did nothing ended up fine. Let's reframe what results actually look like. Most people measure their financial progress by asking, "Am I rich yet?" That question has no useful answer in year 1 or year 5. It's not designed for a long timeline. The better question is my system correct? Do I have an account? Is money going in automatically every month? Are my funds diversified and low cost? If the answer to those is yes, then you're not waiting. You're already winning. The results are just on a delay. Speed feels productive. Watching charts, researching stocks, reacting to news. It feels like doing something. It feels like work. But in investing, that kind of busyness is usually the enemy. Every unnecessary trade has a cost. Every panic sell resets your timeline. Every get in now before it's too late moment is a distraction from the actual job. The actual job is boring. And that's the point. Buffett has said his favorite holding period is forever. Not because he's unusually patient as a personality, but because he understood the math early. Every year you stay invested is a year the curve gets steeper. Every year you exit and re-enter, you interrupt it. The people chasing speed are not crazy. They're just working with incomplete information. Nobody explains compounding in school. Nobody shows you the actual numbers. Instead, you see ads for trading platforms, hear about someone who made 300% on a crypto trade, and the brain connects those dots. Fast money is real money. But that crypto trader either got lucky in a narrow window and doesn't talk about what came after, or they're still trying to recreate it. Luck is not a system. A system is what survives when luck isn't around. Buffett didn't win by being faster than everyone else. He didn't have better technology or more information. He won by building a system early, trusting the math, and not stopping. Over 54 years of flat-looking progress. Then the curve bent, and nothing else mattered. The fastest path to real wealth has always been the same one: